Nasdaq's a little sluggish today because NVIDIA and a few other key stocks are down, but for many of us in markets, given tech's dominance, we kind of just use it as the default index now. Kevin Davitt, head of index options content at Nasdaq, certainly thinks about it that way. Here with me in studio, Kevin, great to have you.
Thank you for having me. I am excited to be here.
I appreciate that. All right, so when you think about what drives the market on any given day, obviously with Nasdaq, you have the tech-heavy trade. I've kind of defaulted to that too, but then we see where it kind of bites us both ways, the concentration when NVIDIA is down on a day like today.
You're absolutely right. I think bigger picture, it's interesting to hear someone in your demographic and your level of sophistication to think that way. I'm a bit older, and I've been in this business for a long time, and I think back to when I started now through the lens of index options. The Dow was kind of a default not that long ago.
Sure, yeah. And now it's like if you go lead with the Dow, as a news person, people are like, the Dow, why would you do that?
Right, no knock, but times change. And I think that you see fund flows change, and I think that your clients' portfolios more often resemble the makeup of the Nasdaq-100. And we're seeing knock-on effects in the index options and the growth we've seen there over the past couple of years in particular.
Are people doing it directly on the index trading? Are they trading the ETFs through Qs? Obviously, we've seen some of the call option surge throughout the AI momentum the last 6 months. So tell me where you're at right now, what you see.
Okay, so talking 18 months, that narrative around AI, I think, certainly focused a great deal of attention on both the Qs, the NDX options. XND is our smaller product notionally, and that continues to a certain extent today. Over the past handful of years, volume has grown on the ETF options as well as on the index options side. Relative to what in the index options world is kind of the default and the S&Ps, we have outpaced their growth during what has been kind of a golden era for index options. I would like to think that will continue. There has been very significant growth in Qs options. There's important distinctions between ETF options and index options. I think most of your clients understand that, but it's a message that we continue to tell.
You've got a pretty good visual showing the growth of the average daily volume, and this is just the volume of the index traded, right? Not options, but the Nasdaq up 135%, or is this options volume?
That is average daily volume relative to 2 years ago.
Okay.
So if you look at that broader picture, S&P volumes are up something like 90%. Nasdaq-100 average daily volumes are up over right around 135%.
Yeah, yep.
Also, in terms of the timing, if you sort of look at where that real rapid pickup over the past kind of 4 quarters, 5 quarters, some of that narrative around AI, which I don't believe is going away, really sort of influenced the market. And I think some of the hedging and overlay activity, we're seeing more of it flow into that index.
Okay. The zero data expiry stuff has also contributed to the just amount of options traded. The tech story from innovation as well. Are there any structural adaptations then when like managing the index and managing liquidity? Does that present any challenges, or is it mostly just opportunity?
So you bring up a couple of points. I would say that the outgrowth of short-dated options has been a benefit sort of across the landscape. When you talk about capacity, we don't think just in terms of a single product, because the Nasdaq-100 ecosystem, that's a little bit fluffy, but the amount of liquidity in index products, when you include the future side of the business, the ETF side and the index side, these markets remain very robust, and the ability to get whatever you need to done very, very quickly and efficiently has been the case for years. So I don't think that there's an issue there. I think what's interesting is to see how quickly both individual traders and institutional types have figured out ways to monetize and to customize their risk and exposure over discrete timeframes using these shorter dated options.
Gives you literally more options. Filling in pieces of the puzzle, that otherwise have been kind of clunky, that people are able to kind of, on the margins, really get specific in the exposure they want at any given time. Does that Is that a live by the sword, die by the sword thing? Like what if we find out, and I don't think this, but we've gone through a few hype trains in tech over the last 5-6 years. What if NVIDIA, let's say like worst case scenario,
Sure.
they did double booking numbers or something, right?
Sure.
So, like a black swan type situation for AI. What role does that have then when you have that kind of concentration in the index? Does that create more of kind of a beta to that index than there would have been 5 years ago or even a couple years ago?
There's a potential element of that, and I think concerns around that potentiality will continue to exist because that sort of fear and greed motivates and drives markets
Sure.
across time. When you talk about concentration, that also exists across both sort of large cap indices. And when I think about the names that have really propelled portfolios and the indices for more than a decade now, you see that in the construction of the Nasdaq-100. That's not to say they're not, but the weightings are different. Now, on your NVIDIA or any other example, you would see that play out probably in an uglier way in the individual security. Mm-hmm. One of the benefits of any index, no matter the sort of concentration, is that it is broadened out. And what we've seen in large part this year is a lot of dispersion.
Yes.
We were talking before we came on about the fact that the past couple of weeks, the names that have led for the better part of the past 2 years haven't necessarily been doing that. NVIDIA today.
Lo and behold, Apple comes in.
Exactly, right. After a couple months of underperforming, and now we're talking about utilities. I think this is a good sign. Do I think that utilities are going to drive the future? No, but I think it's healthy for the broad market.
Well, the dispersion even within the mega cap world is a very compelling point from the NASDAQ side, because the argument then is like, well, you don't need to have 400 other companies to diversify. There's actually now some dispersion within big tech itself, which is key. Good stuff. Great to catch up. Thanks a lot.
Thank you for having me.
Of course, Kevin Davitt, head of index options content at NASDAQ.